If you observe carefully the behavior of cash over the past 4 years, you'll notice something disturbing. While most people were focused on stock market volatility and real estate corrections, their cash savings lost more purchasing power than at any point since the early 1980s. A dollar that could buy a basket of groceries in 2020 now buys roughly 60 cents worth of the same items. That's not a theory, that's your lived experience at the grocery store, the gas station, and the pharmacy. And here's what concerns me. The forces driving this destruction are accelerating, not slowing down. By the end of 2026, if current trajectories continue, cash holders will experience a cumulative purchasing power loss approaching 40% from where they started in 2020. This isn't about missing investment gains. This is about the systematic erosion of decades of disciplined saving. But here's the critical point most people miss. This isn't happening by accident. It's happening by design. And once you understand the mechanism, you'll understand why holding cash in 2026 represents one of the greatest financial risks for retirees and near retirees in modern history. This isn't a prediction. It's a logical consequence of observable policy decisions that have already been made. I've spent over 40 years studying how economies work, how central banks operate, and how wealth transfers occur during these transitions. When you understand incentives, you understand behavior. And right now, every major institution, from the Federal Reserve to the largest sovereign wealth funds, is operating under incentives that guarantee continued currency devaluation. Let me give you 3 specific data points that illustrate this reality. First, the United States government debt is now $38 trillion, with mandatory spending exceeding revenue by approximately $2 trillion annually. Second, the Federal Reserve's balance sheet, which stood at $900 billion before 2008, now exceeds $7 trillion. Third, the velocity of money, how quickly dollars circulate through the economy, remains suppressed, meaning each new dollar printed has diminishing economic impact, requiring even more printing to achieve the same result. These aren't opinions. These are numbers from the Federal Reserve's own publications. The fundamental mechanism destroying cash value is simple. There's too much debt to repay with honest money, so authorities inflate it away. Think of it like a restaurant with more dinner reservations than available tables. The restaurant has 3 choices: turn people away and admit failure, build more tables, which takes time and money they don't have, or squeeze more diners per table and reduce portion sizes so everyone gets served but nobody gets a full meal. Governments facing unpayable debt face similar choices: default explicitly and destroy confidence, grow their way out, which requires productivity they lack, or devalue the currency so the nominal debt gets repaid with diminished dollars. They always choose the third option, always. Right now, 4 major pressures are converging to accelerate this process. The first pressure is demographic. 10,000 Americans turn 65 every single day, claiming Social Security and Medicare benefits the system cannot fund from current revenue. The second pressure is geopolitical. The weaponization of the dollar through sanctions has motivated major trading nations to reduce dollar holdings, diminishing global demand for U.S. currency. The third pressure is structural. Productivity growth remains anemic at roughly 1.4% annually, while government promises require 6 to 7% growth to fund. The fourth pressure is political. No elected official survives telling voters they must accept lower benefits or higher taxes. So the path of least resistance is always monetary expansion. History is an excellent teacher if you're willing to observe its patterns. In 1971, President Nixon closed the gold window because foreign governments were redeeming dollars for gold faster than U.S. reserves could sustain. The immediate result was a 10-year period where cash lost approximately 60% of its purchasing power, while gold, commodities, and hard assets surged. People who kept wealth in cash savings accounts earned perhaps 5 to 6% interest annually, while inflation ran 8 to 13%, guaranteeing losses. During the 1970s inflation crisis, 2 identical families with $100,000 in savings made different choices. The Johnson family, concerned about stock market volatility after the early 1970s crash, kept everything in bank certificates of deposit, earning the going interest rate. The Martinez family, uncomfortable with stocks but recognizing inflation, split their holdings between Treasury inflation-protected securities once available, commodities, and real estate. By 1982, the Johnson family's $100,000 had grown nominally to approximately $180,000 from accumulated interest, but the purchasing power of that money had fallen to roughly $70,000 in 1971 dollars. They could buy less with more numbers. The Martinez family's portfolio had grown to approximately $340,000 with purchasing power of roughly $135,000 in 1971 dollars. Same starting point, radically different outcomes. Let's look at Weimar Germany between 1918 and 1923. The pattern is instructive not because America is becoming Weimar, it isn't, but because the mechanism is identical at different speeds. Germany faced unpayable war reparations and reconstruction costs. Rather than default, they printed currency. In 1918, a German mark exchanged for roughly 25 cents. By November 1923, it took 2 trillion marks to equal $1. People who held cash in banks saw their life savings become worthless. People who owned businesses, real estate, foreign currency, or commodities maintained wealth. The speed was extreme, but the principle applies universally. When governments face unpayable obligations, they devalue the currency. More recently, in 2008, the global financial crisis prompted unprecedented monetary expansion. The Federal Reserve dropped interest rates to near zero and began purchasing trillions in assets. Many retirees, trained by decades of experience that cash was safe, kept substantial emergency funds and living expenses in savings accounts, earning essentially nothing. From 2008 to 2020, official inflation measures suggested roughly 20% cumulative inflation, but real-world costs for healthcare, education, housing, and food rose 40-60% for most Americans. Those cash holders lost purchasing power every single year while earning negligible interest. Meanwhile, the S&P 500 rose approximately 400%. Bonds provided positive real returns until recently, and real estate in most markets doubled or tripled. This isn't made up. It's the typical pattern when monetary authorities choose inflation over default. To understand what's happening to cash in 2026, you need to understand 3 fundamental principles. The first principle is that all currencies are relative value systems, not stores of absolute value. Think of currency like a claim ticket at a coat check. The ticket itself has no value. Its value derives entirely from your ability to redeem it for the coat you deposited. If the coat check issues more tickets than they have coats, your ticket becomes less valuable because the claim it represents is diluted. When central banks create new currency, they're issuing more claim tickets against a relatively fixed supply of goods and services. Each existing claim ticket becomes less valuable. Right now, the Federal Reserve is creating approximately $2 trillion in new claim tickets annually through deficit spending, while the actual productive capacity of the economy grows maybe 2 to 3% annually. The math doesn't work. Each dollar represents a smaller claim on real resources. The second principle is that institutional incentives create predictable outcomes. When you understand incentives, you understand behavior. The Federal Reserve has dual mandates: maximum employment and stable prices. But it has a hidden third mandate that supersedes the other two: ensure the government can finance its operations. If Treasury bond auctions fail because interest rates rise too high, the entire system collapses. Therefore, the Fed must keep interest rates low enough that debt remains serviceable, even if that means allowing inflation to run higher than their stated 2% target. This isn't conspiracy, it's observable reality. Look at their actions, not their words. They raised rates in 2022, 2023 to combat inflation, but reversed course before inflation returned to target because economic stress became politically untenable. The incentive structure guarantees currency devaluation over time. The third principle is that purchasing power transfers don't disappear, they redistribute. Your cash losing 40% of its value doesn't mean that value evaporated. It means it transferred. It transferred to those who borrowed money and repay it with cheaper dollars. It transferred to those who owned assets that appreciated nominally faster than inflation. It transferred to governments who owe nominal debts but collect taxes on inflated incomes. The seesaw of purchasing power doesn't break, it simply tilts. Right now, that seesaw is tilted heavily against cash holders and toward asset owners and borrowers. Understanding this isn't pessimistic, it's realistic. And realism allows you to position yourself on the right side of the seesaw. Let me tell you a story about two couples I observed in the early 2000s. The Andersons and the Patels, both in their mid-50s, both with approximately $500,000 in retirement savings accumulated through decades of disciplined work. The Andersons, having experienced the 2000-2002 tech crash, decided they'd had enough of market volatility. They moved everything to high-yield savings accounts and CDs, earning 4 to 5% annually, feeling safe and sleeping well. The Patels felt uncomfortable with extreme stock concentration too, but recognized that cash earning 4% while inflation ran 3% meant they were barely breaking even in purchasing power. They created a diversified allocation. 30% in a broad stock index, 20% in tips, 20% in a global bond fund, 15% in real estate through REITs, and 15% in commodities and precious metals. They kept only emergency cash. By 2020, 15 years later, the Andersons' $500,000 had grown to approximately $925,000 from compound interest. Impressive numbers. But here's what matters. Inflation over that period totaled roughly 45%, meaning their purchasing power had grown to only about $640,000 in 2005 dollars, a real gain of just 28% over 15 years, or about 6% annually. They'd protected capital in nominal terms but barely outpaced inflation. The Patel's portfolio, despite experiencing multiple corrections and volatile periods, had grown to approximately $65 million. Even after accounting for the same 45% inflation, their purchasing power had grown to roughly $14 million in 2005 dollars, a real gain of 128% over 15 years, or about 6% annually. Same starting point, same time period, but the family that understood inflation risk positioned themselves on the right side of the seesaw. This isn't made up. It's the typical pattern in inflationary environments. Now let's translate this to what really matters, how this affects you. If you're 55 years old with $600,000 in retirement savings and you're keeping $200,000 of that in cash savings accounts because it feels safe, here's what the 40% purchasing power loss by end of 2026 means in concrete terms. That $200,000 in cash will nominally remain $200,000. Your bank statement will show the same numbers, but its purchasing power will have fallen to approximately $120,000 in today's dollars. Let's make this even more specific. Right now, your $200,000 covers roughly 40 months of a $5,000 monthly retirement budget. After a 40% purchasing power loss, that same nominal $200,000 covers only 24 months of an inflation-adjusted $8,300 monthly budget needed to maintain the same lifestyle. You've lost 16 months of financial independence without touching the principal. You've lost more than a year of retirement security, while the numbers in your account stayed the same. Here's the mathematical reality. If inflation averages 6% annually over the next 2 years, which is actually below what we experienced in 2021-2023, your cash loses 12% in year 1, then another 12% on the reduced base in year 2, compounding to approximately 23% loss over 2 years. But that assumes inflation moderates. If inflation remains elevated at 8 to 10% annually, or if we experience a spike driven by geopolitical disruptions, energy costs, or monetary policy errors, the 40% cumulative loss becomes not just possible, but probable. The most concerning aspect isn't the average case. It's that cash has unlimited downside and zero upside. Stocks can fall 50%, but can also rise 100%. Bonds can default, but can also preserve purchasing power. Real estate can decline, but provides utility and income. Cash can only lose purchasing power in inflationary environments. It has asymmetric risk. Based on these principles, here are practical guidelines. This isn't about abandoning cash entirely. You need liquidity for emergencies, and you need psychological comfort to avoid panic decisions.
But strategic cash management in an inflationary environment requires different thinking than what worked in the 1980s, 2010s. For someone in or near retirement with substantial savings, consider this allocation framework. Maintain 6 to 12 months of living expenses in cash savings accounts for immediate emergencies and psychological security, approximately 10% of total assets for most people.
Allocate 35 to 40% to diversified stock index funds that represent ownership in productive businesses that can raise prices with inflation. These aren't speculative. They're stakes in companies that own real assets, employ real workers, and generate real cash flows. Allocate 25 to 30% to Treasury inflation-protected securities or I bonds, which explicitly adjust principal with inflation, protecting purchasing power. Allocate 15 to 20% to real assets, including real estate investment trusts, commodities, or precious metals that historically maintain value during currency devaluation. Allocate the final 10% to short and intermediate-term bonds for stability and income. What to avoid is equally important. Avoid long-term bonds paying fixed rates below inflation. You're guaranteeing real losses. Avoid cryptocurrency as an inflation hedge unless you deeply understand the technology and accept extreme volatility. It's speculative, not proven. Avoid individual stocks unless you have expertise. Diversified indices reduce company-specific risk. Avoid making sudden wholesale changes. Transitioning over 6 to 12 months through dollar-cost averaging reduces timing risk and emotional decision-making. Avoid paralysis from perfect information seeking. Having an imperfect plan implemented is better than having a perfect plan that remains theoretical. The psychological preparation is critical. You'll experience market volatility. Stocks will have corrections. Bonds will have periods of negative returns. Commodities will fluctuate wildly. This is normal and expected. The alternative, watching cash steadily lose purchasing power with certainty, is worse. The common pitfall is abandoning the strategy during the first correction, usually within the first 6 to 18 months, returning to cash, and then watching from the sidelines as assets recover and cash continues declining. Successful implementation requires accepting volatility in exchange for purchasing power protection. It requires understanding that nominal losses in a correction often still outperform real losses from inflation in cash. Nothing in this constitutes specific financial advice. Each person has different circumstances, risk tolerance, time horizons, and needs. Some people have pensions that adjust for inflation, reducing their need for inflation protection. Others have health issues requiring liquidity. Some have estate planning considerations. Some have concentrated risks requiring different diversification. Consult qualified financial professionals who can evaluate your complete situation before making allocation changes. The choice is yours. But remember what's happening behind the scenes. Central banks around the world are diversifying away from dollars. The People's Bank of China has been a net buyer of gold for over 15 consecutive months. Central banks globally purchased over 1,000 tons of gold in 2023 alone, the highest level in decades. They understand currency risk. Sovereign wealth funds are increasing allocations to real assets and inflation-protected securities. They understand purchasing power risk. The world's largest pension funds have reduced cash allocations to minimum operational levels. They understand opportunity cost. These institutions aren't making these moves based on speculation. They're making them based on the same observable reality you can see. Too much debt, too many promises, too few productive resources, and the mathematical certainty that currency devaluation is the path of least political resistance. That's why this channel exists. Not to create fear, but to create understanding. Not to sell products, but to share principles. The signals are visible if you observe carefully. The historical patterns are clear if you study them objectively. The incentive structures are predictable if you understand them honestly. We observe signals before they become obvious. We examine what institutions do, not what they say. We focus on principles that transcend specific market predictions. If this analysis makes sense to you, if it helps you understand forces affecting your financial security, subscribe to this channel. We'll continue examining these patterns, updating observations as circumstances evolve, and translating complex economic mechanisms into practical understanding. The cash under your mattress or in your savings account will be there tomorrow. The numbers won't change. But what those numbers can buy will change dramatically. The dam holding back monetary expansion has cracks that widen daily. The pressure behind that dam, $38 trillion in federal debt, unfunded entitlement promises, geopolitical fragmentation, political polarization, isn't decreasing. When you understand that cash is a claim on future resources rather than a store of value, when you understand that all currencies are relative value systems rather than absolute wealth, when you understand that institutional incentives guarantee continued debasement, the logical action becomes clear. Protect purchasing power, not nominal numbers. Position yourself on the right side of the seesaw. The choice has always been yours. Make it based on principles, not emotions. Make it based on observation, not hope. Make it today. Incognito chats aren't saved to history or used to train models.